So what's going on, everyone? So today I have another special guest. My main man, Mr. Tony Battista. No, not Tony Battista, the baseball player, but this Battista probably wrote a few checks for that Battista. but this Battista, he started his career in options and futures trading in 1983 as an independent market maker at the Chicago Board of Options Exchange. He also worked as a local independent trader at the Chicago Board of Trade, where he traded the 30-year bond future. Now, while primarily being an independent trader in the S&P 100 index pit, he also spent 3 years in the AOL equity pit. And he also served on the CBOE, Chicago Board of Options Exchange Arbitration Committee for over 10 years, ruling on disputes between traders and trading firms prior to joining Thinkorswim. You know, I can go on about his experience and his accolades, but I actually want you to hear from the man himself. Bat, what's going on?
I'm doing well, man. Thanks so much. I appreciate your time and appreciate you introducing me to your audience. That all sounded real, real fun and good and stuff like that, but there was no script when I started.
Okay.
I actually left New York in 1980 and drove to Chicago and finally started as a trader, as a market maker in 1983. But for 3 years, I was a grunt like everybody else, making $600 a month, as a runner on the floor of the CBOE. So it wasn't all, arbitration committees and market making and having a great time. There was a lot of effort to get there.
I mean, but you got to start somewhere, though, right? And
absolutely.
Look at you now.
Absolutely. Unless, you can fall into it where you've got, a successful uncle or neighbor or friend, but I didn't have any of those.
So now you're that uncle, friend, neighbor.
Yeah, maybe. Yes. Yep. You're true.
So Bat, we both from Brooklyn, opposite sides. It's crazy to me how tastytrade serves as like a fraternity, right? It doesn't matter the background that you come from. It's all, just that one goal in mind, right? We grew up on two different ends of Brooklyn. I grew up in East New York. You grew up in Bensonhurst, right?
That's correct. My father and mother were both born in East New York, Red Hook.
Nice.
In Brooklyn.
Mm-hmm. Okay.
Yeah, more close to you.
That's where the good old Lloyd Blinkfond is from as well.
Yep.
So it's funny because you went to James Madison, right?
Yes, I did.
So I went to Canarsie. I got there in 2007, and I played baseball. And yeah, we haven't beat them in 7 years. So my freshman year was our first time beating Madison.
Well, that's the end of this interview. So thank you so much. Go overnight.
I'm kind of telling on myself. I was talking to my lady the other day. I was like, I wonder if he knows Judge Judy, and she was like, "Is he that old?" I was like, "No." I should have thought about that before I said it.
I'm old enough, man. 57. I guess I've been around the block a few times.
Hey, it's 57 going on 18, huh?
Yeah, well, I don't know about that anymore, but yeah, I'm trying.
But Bat, I really appreciate this time.
Cool.
It's really, like I said, I just really want to dive in just to get to know a little bit about your experience. Just your outlook on the market. You starting out as a market maker, independent trader, now being a retail trader. How that has affected your strategies over time. Now, Bat, why did you go into the financial industry?
I didn't have a good blueprint for anybody else to help me. I mean, for me, in Brooklyn, if your father's a bricklayer, you become a bricklayer. If your father's a doctor, you become a doctor. If your father's a hoodlum, you become a hoodlum. My father wasn't a bricklayer and he wasn't a doctor, so I didn't have too many choices on what to do. And New York at that time in 1980 was basically bankrupt, but they had just started hiring for police and sanitation and fire department. So all the kids my age, 18 years old or so, were signing up to go work for city jobs because everybody, city job was a great pension, and that's the neighborhood I came from. We're kind of those type of working class people. But I had a cousin who moved to Chicago with Shearson Lehman Brothers, who's no longer around anymore, and they had just started this option trading, this CBOE, Chicago Board of Options Exchange. They started in 1973. This is 1980. So it was an easy point of entry, meaning a low entry to get in. A seat on the New York Stock Exchange was $1 million, and a seat on the CBOE at the time, you could get in for as little as $30,000, which I didn't have. I left New York with $300 in my pocket and my mom's Dodge Diplomat, but it was my start. So I left because I really just didn't want to be a police officer. I didn't want to work for the city. And my mom was a waitress. I didn't see any, kind of upside there. My dad wasn't around. So it seemed like it was like, burning my burning my boat, but because I really didn't have a big boat to burn, so it was an easy decision for me. It really was. It wasn't an only child. I didn't have a lot. I didn't have a lot of reasons to stay that were kind of on the upswing.
Okay. Now, when it came to you just making that move and then having to adjust, how long would you say it took you to say, hey, you know what, this is actually something I want to stick with, and I'm gonna keep going?
I think immediately. So when I went to work at the Chicago Board Options Exchange for a firm called Brandt and Associates, which is no longer there, it was a market maker firm. So market makers, let me back up for a minute. Market makers are the they. So like you may have, and people may be listening, they may have an account at Merrill Lynch, or hopefully they have an account at my brokerage firm, which is Tastyworks, or they have a broker account someplace else. You're doing it all electronically today, but back in the day, you would actually call somebody up. That would be your broker. Your broker would then call the CBOE, and they'd have like a penny broker, they would call them, somebody that they would use on the floor. And then that person would run into the pit and execute the order with a market maker. So the market maker was really the they. Who bought and sold everything that the public wanted to do was a market maker, not your broker, a market maker. I was one of those. And when you get to see their attitude, and you get to see their big houses, and they all have pools, and it was an easy transition that you wanted to be like them. It's the same thing like if you're on the street, man, and you've got that one guy in the neighborhood who's got a nice car and flashy clothes. You want to emulate him. You want to do exactly what he's doing because he's got the nice things. And it was the same thing here. It was just it was completely legal. Yeah, and it was like Dracula watching the blood. You were the they. So
yeah,
you were the man. So it was pretty easy to want to be like them. Now, everybody wants to be like them if you're exposed to that, but it wasn't very easy to do.
Absolutely not. Because one thing I always get confused about is the workload. Because like you said, you call your broker then calls the market makers.
Yep.
But if you have a company, just even one company that has millions of volume a day, like how did that work?
It's organized chaos. I mean, it's gotten a lot easier now with electronic trading. But back in the day, you really would stand in a pit with a pad, very similar to this, and you would just write things down on a card, and you would have a clerk who would check your numbers for you, make sure exactly what you had, and it was really a guesstimate at the end of the day. You had a good idea because it's money on the line. Right. I mean, if you're making a bunch of parlay bets or anything else like that, you kind of know which way you're leaning. I want to bet the Rams. I want to fade the Giants. That's what you're doing all day long. You understand what you
out of all teams, you had to go against the Giants, though.
Listen, I'm a New Yorker at heart, but I'm a Chicago Bear fan now.
Well, I mean, you've been there. I guess you've been there quite a while, right?
I've been in Chicago longer than I lived in New York. So sure.
It's funny because I was a Giants fan because I thought my dad was a Giants fan. But, I mean, just growing up, all we saw was the Giants. But it just so happened that every time we were together, the Giants were just playing. So he's a Jets fan the whole time. And I just found myself. I couldn't switch up.
Sometimes knowledge is power. Sometimes it's not.
Yeah, not at all. Not at all. Did you did you catch the Last Dance last night with Jordan?
I did. I actually it was really kind of cool because that was my era when we were going. It was the barn at the time. You're talking about the Last Dance with Jordan, correct?
Yep.
Yeah. We were there when there were 2,500 people in the stands instead of 18,000.
Right.
Yeah, it was pretty cool. It was pretty cool. It brought back a lot of great memories.
Yeah. Now, I mean, you have a really interesting background. You basically started out as a waiter, right? And then you worked your way up to the CEO and whatnot. Yeah. Now, of course, just throughout your time, on the floor or whatnot, what was your motivation? What was your inspiration to attempt to get a seat on the exchange? And what's the story behind that?
We already said I was 57 years old, and I've gotten to the point in my life where I don't have to lie anymore. Right. So, maybe when you're a little bit younger, you got to tell some fibs, and I really don't give a shit anymore.
Let me know what point you have to stop because I'm still working towards that.
No. Well, it takes a long time. I'll give you that. I don't know. One investor's floor is another investor's ceiling, so you never know. I mean, it was nothing motivating than, I didn't want to pick up quarters like my mom was as a waitress, and I didn't have any I didn't go to college, and this was a place, and maybe it was just fortuitous, maybe it was just luck, maybe it was skill, maybe it was just pure determination. I don't know, but it was a place where everybody was level. Didn't matter how what background you came from, what education you had, what nationality you were, as long as you had your word, because everything was done by word of mouth. There was no contract signed. It was just, I say buy them, you say sold, I say 10, you say 20, let's do 15. We settle on 15 and we settle a price, and then that's it, it's done. So as long as you had your word, that's all you needed. And so if you didn't go back on that, it was you had an opportunity to walk out of there with a couple of loaves of bread under your arms. But not everybody did. You know what I mean? There were, I think at the time, there were maybe like 1,800 seats, which is really like those are the guys that own the business. And then everybody else kind of rents a seat. So you can actually be there before you own your seat. So I would rent my seat sometimes as much as $7,000 a week just to rent the seat. So you had to make $7,000 before you broke even.
Okay.
So in a week. So it wasn't like, the point of entry was real cheap. It was cheaper than New York, but it was still very expensive, and you still had to perform. So it took me 3 years is what your next question is going to be. So from 1980 to 1983, I saved about $25,000, and that's what I started trading with. Gotcha. And if your seat lease is about $7,000 to $15,000 a month, because it fluctuated with the seat price, you can do the math. You don't last very long if you don't make money very, very quickly if you're only starting with $25,000. Now, when I left New York, I had $300. So if you told me I was going to have $25,000 in 3 years, I'd say you were a liar. Right. So, everything is relative.
Okay. Now, with the rent or like the lease that you were paying, is that at least just securing your spot on the floor to be able? So if you
own the seat as an investment, you could rent it to me. You stay in your beautiful apartment, condo, house, whatever it is, and I pay you for just being able to use. It's just like renting a house.
That's interesting. Now, just in regards to the pits that you were actually in, why the OEX?
So the OEX was the first. There was no such thing as like SPY. The Standard & Poor's 500. It was the OEX, which was the 100. It was the 100 most capitalized stocks as one conglomerate, like an ETF is today. It was called an index, but it's just like an ETF today. So when you hear, the Russell or the Dow or the S&P, there really was the Dow, of course, and then the OEX. It was the biggest pit, and it was most young guys, because the older guys like myself and maybe like the 30 and 40 and 50-year-old guys, they were more into the equities, like the IBMs of the world, the Schlumberger of the world, Kerr-McGee, more the established stocks going back to 1980, 1990.
Like the blue chips?
The blue chip stocks, yes, it's correct, 100%.
Okay. Why do you think that? Why did you think it ended up being that way, like that setup?
Well, the OEX was a new product, so nobody knew if it was going to, take off. So it was a speculative product. Gotcha. So think about it. You've got a nice house on the lake in Chicago, and you've been standing in this IBM pit for the last 10 or 12 years. Are you going to move your ass over and start banging with these young guys who knows what their reputation is? They were undercapitalized. We were all undercapitalized. But with any new product, it's like a new thing. Like if you work for Nike and you're a big manager for Nike, and all of a sudden a new shoe startup wants to grab you and say, "Hey, I'll make you give you a higher position in my company," but you don't know if the company's going to be around in a month or two. Are you going to move? I don't know. Most people wouldn't, and most people didn't on the floor. So they gave them away. They encouraged, the younger, undercapitalized traders to go in there.
Yeah, and it's funny you say that, because if we go to more so like a more established company, are you familiar with the story behind Ron Artest and like vitamin water?
You know what? I heard it 100 times, but I don't remember it. I remember he. I actually thought it was. I thought it was a rapper who. What 50 Cent?
So get into that. So they originally approached Ron Artest. Oh, okay. Like, hey, we want you to be the brand ambassador, and he wanted 200,000. They were like, hey, we really don't have 200,000, but we can give you ownership equity in the company. He's like, well, you either pay me or leave. And they're like, hey,
Right.
you have to leave. So they approached 50 Cent. They gave him ownership equity. They sold it to Coca-Cola for $1 billion. I think he cashed out, what, like 400 million?
Something like that.
So,
Probably
yeah.
more there than he did on his record.
But it goes back to your point, that more established brand. So Ron Artest is like, hey, do you know who I am? I want
Right.
established brands and whatnot. So he didn't foresee the upside, I guess you would say, right?
Yep, for sure.
Yeah. Now, is that what took you actually going back to the OEX? And then I noticed it was like XEO. Are those mostly like European options?
Yeah, they can be exercised at any time, which makes them
still made them American.
Yes, still made American. Prior to the OEX, which started right around 1980, 79, 80, something like that.
Mm-hmm.
Prior to the OEX, if IBM was if IBM was upticking, the whole market would uptick.
Gotcha.
If IBM was downticking, the whole market would kind of downtick. See, now I'm gonna partake with you too.
Hey, might as well.
Oh, Kronberg, just a little beer.
Salute.
So it wasn't very broad based. I mean, IBM is a wonderful company at the time and still okay, although it hasn't performed well in the last 30 years. But it was something to watch. Like everybody was looking for an indicator on how the market was going to move in the next 2 minutes or 20 minutes later. When the OEX came around, it was the 100 most capitalized stocks in one big basket. Okay. So what the old timers didn't realize at the time was we were actually taking their market share because we were becoming the leader in the market, and the older established stocks were actually becoming the less attractive vehicle, because here you got exposure to 100 different stocks, just like the S&P 500 gives you exposure to 500 stocks. Mm-hmm. If the market goes higher, all 500 might not go higher, but that product is going higher. It's an absolute. The market can go higher, and IBM does not have to go higher.
Gotcha. So, and it's funny,
more of a one-on-one play.
It's funny when you mentioned IBM being like that market player at that time. So it's really one of those those market movers. So would you say it was like a tier 1 or tier 2?
IBM or OEX?
IBM at the time before.
Oh, at the time it was a tier. It was the tier. It was its own tier for sure. Okay. At the time. That's but things move real quickly. I mean, you can look at the top 10 biggest stocks today. Will not, of those top 10, maybe 2 or 3 at most will be the top 10 stocks 10 years from now. It's a complete rotation of things. But at that time, IBM had held it for quite some time.
Gotcha. Is that one of the reasons you decided to go into the AOL equity pit? Because I remember when I was growing up, we had AOL was huge.
Yeah.
Growing, booming. Was that one of the reasons you went there?
So it was actually timing, for me at least. So we're all the way to 1999. So we went from 1980 when I was a runner to 1983 when I first started trading. 1987, the day of the crash, I bought my seat on the exchange, which was kind of a funny story. The seat was trading for around $360,000 at the time, and I put in a $260,000 bid months prior. Okay. Because what you had to do was you had to have at least 50% of the money up front. Like a house you can buy now for 10% down or 15% down. If you wanted to buy a seat, you had to have 50% down. So as young traders, whatever cash you had, you would put in. So you can buy your home, buy your seat. You can own it. There can always be a Watson on the floor of the CBOE, or there can always be a Battista on the floor of the CBOE. So I put in a bid at $260,000, which tells you from 1983 to 1987, I was able to save $130,000. So that's how I was kind of making money at the time, really starting from nothing. And now, 4 years later, I've got 6 figures or more saved on the side, which is pretty cool when you're, just a thug from Brooklyn at the time, not this cultured human being that you see before you today.
We all have a past, right?
Right. So the crash comes, I get to buy my seat. The market rebounds very nicely from that day moving forward. The seat goes back to $360,000 and stays there for some time, works its way up to $1 million and then up to $5 million at one point. And that's subsequently come down a little bit from there. But anyway, so now we are at 1999, 98, and the CBOE is kind of drying up. The OEX, I went from trading 2,000 to 3,000 contracts a day to trading 30 or 40 contracts a day.
Okay.
You know, trying to make the same amount of money I was making when I was trading 2,000 contracts a day. So I was risking a lot more money to make a lot less money. Just the opportunity, the business had just dried up and changed. Okay. So I went over to the Board of Trade, which is the CBOT, the Chicago Board of Trade. I went over there and tried to trade the 30-year Board of Trade. I had some of my biggest swings, positive and negative. I did not enjoy the product trading the 30-year bond at all. I liked the gray area, the nature of options a lot better than the future, meaning I just traded the 30-year bond future. It's either you buy it or sell it. Okay. There was no kind of strategic play to it. So I came back to the CBOE, and that's just when AOL was starting to get very, very busy. I never traded an equity before, so I'd never traded anything with a stock attached to it. So it was kind of relearning everything that I had kind of learned once before. But it was very busy. The markets were very wide. And I had a friend, Scott, who kind of showed me the ropes of how to trade in equity. And it was probably one of the best moves I ever made.
So how did you come across Scott? Did you all meet in the CBOT?
Yeah, we were the two youngest traders. You got to be 21 to trade. Okay. And we were both the same age. We were like a month or two apart. So my birthday was like in July, and his birthday was like in February or something like that. So he started trading that year, a couple of months.
February what for Scott?
Oh, now you're gonna tempt me. Oh, okay. I don't remember. I would lie to you if I told you that. Are you in February?
Yeah, my birthday's February 10th.
Got it. Yeah. So he started trading a little bit before me, but we're the two youngest traders, so we kind of just made friends with each other. Nice. Actually, Beth, who works with us today, that's her uncle.
Oh, really?
Yep.
I would have never guessed that.
Yep. Beth, who works with us, who's our producer of tastytrade, our financial network that we have. She's the producer of it. Her father and him are brothers.
Brothers, so, She keeps y'all in check, with the old Omaha and everything.
Yeah, that's right. She's the Omaha girl. That's correct.
Now, Bet, obviously, you have a really good resume, and extensive track record and whatnot. Obviously, there came some challenges in between.
Sure.
What was a constant struggle for you during that time, and what would you say kept you going to get around that?
I think the biggest mistake, I'm painting a pretty good picture here, and I really did have a pretty strong career of making money, every day. I did 3 months into my career. Remember, we had that conversation a moment ago about how all you have is your word and your honor when you write down something and you say something. I had an out trade with somebody, 3 months trading into my trading career. That was a $30,000 out trade, and I only had $25,000 in my account. So that kind of busted me out at the time. And I had a friend who kind of guaranteed all the rest of my trades. But he told me, I had to make money every day, or, if I started losing money, he was going to pull the plug on me. So I did have that kind of one big hiccup. But really what my biggest kind of regret trading and in business was probably never being able to trust other people and branch out. So the guys who became very successful, or more successful than myself, were able to take what they did, not only show somebody else how to do it, because we all had clerks who we would show how to do it and then form a small partnership with them, and 9 out of 10 of them would never work out. And throughout the whole trading career was kind of like our way of giving back. That's how I started. That's how somebody else will start. But the guys that really kind of took it to the next level built businesses out of it. Like, they were able to take a step back and actually make a career out of it for other people, and actually put themselves in other places in the world. Meaning, I have a style of trading and a thing to do. I'll put somebody who's just like me, pay them, and have them do it at the Board of Trade so they can do it in wheat and corn and soybeans. And then I'll pay somebody else and teach them how to do it at the Mercantile Exchange, where they can trade the E-mini S&Ps and the E-mini S&P options before the Merc and the CBOT have merged. So what they did was they kind of duplicated themselves multiple times, and instead of making 1x every day as one person,
Okay.
They were making 5x, and the 5x was actually making twice as much. They were making 10x, and they kept growing on that. So the ones that were really able, my biggest regret is never kind of branching out like that. I was just so happy to make what I made.
Yeah.
I kept it pretty close to my chest.
Yeah. Would you really say it's a regret though? Because you didn't know. I mean, it's just like saying, you know,
well, it's hindsight. It's hindsight.
Yeah.
You know.
Is that why you got Bat Junior on there? Now it's too.
Yeah. I don't know about that. That was a mistake.
I would say it's a really good mistake.
Yeah, no, he's a good boy. He'd be great. Yeah. I'm an only child. I got 5 children. You know, they're my pride and joy. Every one of them, you know, luckily went to college. They all graduated on time. Nobody's ever served any time. So they're all good kids.
Nice.
Whole thing is everything.
And obviously, because it's the great leadership, right? You know, the good influence.
Yeah. Well, so. They had a good blueprint, but you know, you got to do it on your own too, man. You know, everybody. You know, you watch the movies, or you have the friends who, you know, everybody grows up in the same house, eats the same food, has the same opportunity, and you know, one is just a complete fuck up, and the other one becomes, you know, multimillionaire. You know why? You know, it's inside you, man.
Yeah, and I think that's almost every family, because you know I have that in my family.
Sure,
every family has it. Other end, and I think that is pretty interesting why that happens.
Yep.
You know, but just would you consider yourself a retail trader right now?
Oh, I'm 100% retail trader. That's what I do. I mean, I'm involved in businesses that help other retail traders how to trade. Mm-hmm. And I'm a part of a brokerage firm.
Yeah.
tastyworks, but I'm a retail trader. I pay the same commissions you do.
Yep.
If you're a customer at tastyworks, I don't get any special treatment. My orders go in the same way.
Yeah.
Your orders will go in. Yeah, no, I'm a retail investor.
Now, the only reason I asked you that is because is there a difference between your strategy as you being a market maker, independent trader versus now being a retail trader? Sure.
I mean, the biggest like as a retail investor, your biggest edge is you get to do what you want. Now, you always had that edge, even when I was a market maker in the 80s and 90s and early 2000s. You always had that same edge, but the markets were very wide. So what you wanted to do, you didn't get in at a good price and you didn't get out at a good price. They were fair pricing, but they weren't the fairest pricing. Today, you've got markets that are 1 penny wide. The difference between buying and selling something is legit $1, $1 US. Mm-hmm. Markets are so tight right now. Having the option or having the ability to do what you want to do is quite powerful. As a market maker, you had to take the other side of everything the public wanted to do.
No matter what, right?
Right, no matter what.
And that's interesting how you all had to take on that responsibility, but still you were able to be successful. Because, I mean, to me, it just sounds like, I mean, what about all of the bad trades, right? You know,
yeah, markets were wide. You know, so it's like so you do some real estate and selling and investing and showing people homes and everything else like that. Think about it, like every home that you show somebody to sell, you might not want to live in it yourself, but for the right price, you'd buy it. You're right. And for the right price, you'd sell it if you didn't own it and try to find a buyer, you know, at a cheaper price. So it's all about price. But today with markets basically, you know, 1 penny wide, it's no longer about price, it's about strategy. So that's what I try to teach people is how to trade strategically like a market maker would trade.
Okay. Now, it's funny you touch on strategy because it's a perfect segue into the question that I did want to ask you. Really, you know, I really want you to touch on the importance of focusing on a strategy that touches on probabilities instead of being price driven. Because I'm in groups on Facebook, you know, they're like, hey, you know, crude oil is going to this XYZ, or a price is going to go here, so I'm bullish. But what is the probability of that actually happening? So talk about the importance of that.
Sure. I dare your audience and anybody who wants to watch this or talk to you or contact them to consistently pick a direction on ABC stock or just the market itself. It's never been able to be done. There's billions of dollars chasing the market, and yet there's a buyer for every seller and a seller for every buyer. So that means for a trade to happen, one person has to be happy with the price and one person has to be unhappy with the price. That doesn't mean that the person who sells wants it to go down. Yeah. They may have bought it earlier and they're selling it at a profit. And that doesn't mean the person who's buying it wants it to go up. They may have sold it lower and buying it for a loss. That's not my point. All I can say is a flip of a coin is 50-50. Up or down the market is 50-50. But on entry, if you can control your price on entry, that's strategic.
Okay.
If stock is 100 and you don't like the stock, but you don't lose money until it goes to 105, stock's 100. You don't lose money until it goes to 105. Well, that's a strategic play. You got $5 worth of cushion. The Las Vegas Sands doesn't have $5 worth of cushion on a trade. Like, you know what I'm saying? They build big casinos. Yeah. The same thing on the upside. If a stock is 100 and it takes $1,000 to buy shares of stock, and I can do it for $100, and my break even is 95 with the stock at 100. Today I get in. I don't lose any money if the stock doesn't go under 95. It's trading at 100. If it just stays the same, I make $5. That's strategic. Anything that's better than a 50-50 shot is what a market maker would want to do. If it's a 50-50 shot, then, you know, it's just me trying to be a big fade on you, or you being a big fade on me. Yeah. Nobody gets rich doing that.
That's true. Now, just in regards to going back to what you said, like a 50-50 shot, do you feel like you as a market maker on the CBOE had a better opportunity or a better shot than the market makers on the New York Stock Exchange if they weren't using options?
So the CBOE market makers were the biggest customers to the specialists on the New York Stock Exchange.
Is it because it's derivative?
That's correct. Okay. Remember, listen, they got to find stock somewhere if they need to buy it, and they got to find stock somewhere if a buyer if they need to sell it. Yeah. I can go to you, and I can go to the grandmother in Iowa, and I can go to 8,000 other people to try to find 1,000 shares, or I can come to a market maker and get filled on 100,000 shares.
Gotcha.
So we worked hand in hand with each other, and try to make for a fair and equitable market. We were both liquidity providers.
Gotcha. Okay.
So liquidity provides stability. That's the saying. As a market maker, I was supposed to provide liquidity and stability. Liquidity. I also wanted to make $1 too. So my liquidity might not be the best price that you want to trade it at, but that's where the liquidity is.
Well, I'm glad the Fed doesn't operate that way now, since we need that type of injection, right?
Yeah, well, they're even. I think they're worse than us. I mean, their horns are a little bit bigger than mine ever were.
They try to make it seem like, hey, we're gonna lower interest rates to 0, but it actually doesn't mean 0. But
right. Well, it doesn't mean so. Your credit card's still 20%, or 18%, or whatever it is. The bank do it at 0, but. That's another story.
Absolutely.
See, now the Fed should have said something just like that. Forget about free school and things that'll probably never ever happen. But you've got so much debt right now in credit cards for normal people, like all of us, you, me, everybody. Yeah. If they would have said, okay, your interest rate's no longer 18%, it's 3% over prime, and prime is 0, so you're going to pay 3% now. You just stuck hundreds of thousands of dollars in normal people's pockets, not the banks and everybody else's, or whatever.
Yeah, we'll just call it leverage. We'll just leave it at that, right? Yep. Yep. Now, Bet, obviously throughout your career and whatnot, you've seen it crash and whatnot.
Yeah.
Couple. How would you compare everything that's going on now, all the market activity, the volatility, contraction, expansion? How would you compare that to the crash, your first crash in which you experienced?
Of 87 or so? Information moves so fast now, so it gets disseminated so quickly. Okay. Remember, I was trading before there was a thing called a computer, right? There was a thing, as I was trading before there was a thing called a microwave. So, that's how long and how much the progression has been and change in the market. So I think information gets disseminated so quickly. So fear kind of gets less volatile. So I think the market's been less volatile, although it's been very volatile. It's less volatile than remember, we didn't trade 24 hours, 7 days a week, which you basically do now. We closed at 3 o'clock. The market's closed at 3 o'clock. That was it. 4 o'clock Eastern time, and that was the end of it. You didn't open back up until 9 o'clock in the morning the next day. So there was a lot of uncertainty. A lot of uncertainty brings fear. A lot of fear brings wild swings. I think the markets are actually a lot more tame now than they've ever been.
Really?
Mm-hmm.
So do you think just more so a lot of like news or a lot of events, more so political, or would you say that's more so priced in easier because of these times?
You know, I don't think I'm not a big political guy, so I never like, and I'm not a big news junkie.
Yeah. Me either. This is just a question to have you clear it up.
Yeah, no, I get that. Yeah. I think it's just all good background noise in a story.
Gotcha.
I don't think it has anything to do with future price. You know, it's just like earnings on a stock. I'll go back to just math for a second. You know, ABC stock comes out and they say, you know, their earnings this year are right on target. You know, we hit our numbers, and we think next year is going to be good, but not as good as we had planned. Instead of that stock going higher, it'll probably go lower because guidance was lower. Or if the stock had been on its butt for the last 6 months and they say exactly the same thing, that stock might actually go higher because it's already on its butt.
Right.
So really, I don't think it has anything to do with what people say and people do. I really just think it's price.
Do you think that's the same for crude oil? Because I mean, think about it. It's really just supply and demand. To the normal person, you would think it's supply and demand, right?
Right. So how many? So I don't know how timely this will be, but today crude oil traded at a negative number for the first time ever, and it traded a negative number. Negative $35 is a big number. Remember, this contract started at a positive $60. It never went ever in its history to below zero. It never went to zero. It went to $35 below zero. It started in January at $60.
Yeah.
It's humongous. Now, how could something trade under? Like, how could if you wanted a barrel of oil today, how can somebody pay you $35 to hold the oil?
Like, here, it's yours.
Right.
Yeah.
So just on paper, just on thinking, it's an impossible thing to do.
Okay.
What you have to do is you have to take over 1,000 barrels of oil. You have to prove that you can store the oil, and it costs you $50 per barrel to store the oil. So you may get it at $35 under, but it's really net costing you $15 to hold the oil.
Yep.
But the story is, who needs a Tesla when they can pay you to hold oil?
That is
true.
You know
what I mean?
That is true.
It's an interesting time. It's an interesting time.
It is.
I mean, commodities I've always thought they've been the most. I hate to consider myself a trend trader because I'm not. I'm actually a contrarian. I do the opposite in the stock market. The market's going higher, I typically like to sell into it. The market's going lower, I typically like to buy into it. I think that's how I get my best pricing.
Yeah.
With commodities, it's much more of a trend trade. Like, you will see 8 or 10 days of movement, 8 or 10 days of movement. And it's much more of a black and white instrument, much more of a futures trade than an options trade.
Got you. Now, kind of just going back to, you said you're contrarian, you know, you sell buying a weakness. Now, is that net? Are you going out a little bit further out where you can get it at a lower price to take advantage? That way, later on, once it levels out, you're able to.
So with options, options are just contracts to do something. So I'll go back to your house story for a moment. You know, a house might be $100,000. That's its fair value today. Maybe you might be willing to pay $100,000 for it today. But, you know, maybe it's they're thinking about widening the street, and your home is right next to that street. And maybe 8 months from now, that $100,000 house, if they widen the street, might only be worth $90,000 because it's not going to be as desirable a neighborhood. But if they don't widen the street, it's going to be worth $120,000 just in the next 6 months. Well, let's write a contract on that. I might say, you know what, it's worth 100. My downside's 90. I'll buy your house from you at $95,000. And you say, okay, well, I own the house at 100. It could go to 120. It might go down to 90. I'll cap my risk by 50%, giving it to this jerk if they build that you know, they widen the street. Hopefully they don't widen the street,
Yeah,
I make the premium that I charged you,
absolutely,
and you get to sell your house if you want to at a higher price.
absolutely.
That's all options are. So to me, it's not really like where the house is going, where the stock is going. It's really what's my risk reward.
Got you. Those goes back to the probabilities.
Go back to the probabilities. That's correct. That's
Yep.
correct.
Now, when it comes to with the strategies for focusing on risk reward, focusing on probabilities,
Mhm.
I noticed you're talking about your IRA, you're talking about your individual account.
Sure.
Do you based on the probabilities, do you still make sure that your both accounts? Do you conduct different strategies no matter what because it's a different account?
So IRA accounts have the issue with an IRA account is it takes more money to do the exact same trade that a margin account would do. A margin account uses less buying power, uses less capital to make the same trade. So you can trade ABC stock in a margin account. It might use $5,000 worth of buying power.
Mhm.
I can trade ABC stock in an IRA account, and it might use $15,000 worth of buying power. All of a sudden, I'm using a lot more money to make or lose the same amount of money that you get the chance to make. That's the only difference with an IRA account. Other than that, you can do everything the same. So you got to be a little bit more strategic. I don't want to get too advanced for people with it, but you have to be a lot more mindful of what your buying power is, how much money you're using to do this strategy. And you may do a strategy like a strangle, which is really just, in my example that I gave you from my house, the house was $100,000. I gave you the right to give it to me at $95.
Mm-hmm.
That would be selling a put in the option world.
Right.
And if I wanted to let you buy that house, more houses
Mm-hmm.
at 120, that would be selling a call.
Oh, yep.
So you can sell both of those. That's a straddle.
Okay.
And premium on both sides if it stays in the middle. You're trying to middle something.
Got you.
That strategy you can do in a margin account with a relatively small amount of money. In an IRA account, it would cost a lot more.
Now, is that because you can't do spreads in an IRA?
No, you can do spreads in an IRA. You actually at Tastyworks, you can do every strategy that a margin account can do in an IRA account. I don't know of any other brokerage firm that allows. This is starting to sound like an infomercial that allows you to do that. But we are the first one, and I don't think anybody has the technology to kind of compete with us.
Okay.
So you can sell naked calls, you can sell naked puts, you can sell call spreads, you can buy call spreads, sell put spreads, do any ratio spreads, anything that you can do in a margin account, you can do an IRA account. It just takes more buying power.
More buying power. Why is that though?
Because you can't. It has nothing to do with the risk. You can't, by law, add money to an IRA account unless it's that time of the season.
Yeah, and then you also have that cap.
Correct.
Yeah.
So as a brokerage firm, you'll give me let's say your $20,000 margin account, and you may have $50,000 worth of risk. And for all purposes, if you lost more than $20,000, I got to guarantee those trades. I have to take the money out of my brokerage firm, make those trades good to everybody else, because the process can never break. And then I have to come after you for that extra money.
Absolutely.
Okay, in an IRA account, I can't come after you because you can't add money to an IRA account even if you wanted to.
Got you.
So you have to use more buying power. I have to protect myself.
Okay. So it sounds like you really just want to define your risk a little bit more also.
You want to define your risk. That's correct. So we call it buying wings. So you may, the stock is 100, you sold the 95 put and the 120 call. You may go buy the 130 call, and you may go buy the 80 put. Then you only have $10 worth of risk on both sides. That's $1,000 in my world. Then you only need $1,000 in your account, just like you would in a margin account.
Got you.
Same in an IRA account. That's correct.
Now, would you say, based off of your accolades and your resume, by you trading a 30-year bond yield and whatnot, you seeing like the Fed printing all this money?
I was a horrible bond trader. I might have been a great equity trader. I was a horrible bond trader. Yes.
But do you think it's important for retail traders to understand how bonds work and bond futures? For proper hedging purposes?
It's less important at zero than it was when interest rates were 18% when I bought my first house. Okay. So, I mean, at 18%, there's a lot more room to play and make money. at 0, 1%, 2%. You know, no Fed raising rates. It's not. It's a very flat vehicle. There's not a lot of volatility to it.
So it's kind of like trying to sell when IVR is below 20.
Right, IV rank. That's correct. That's correct. That's correct. Yeah. So it's like it's snowing outside and you want to sell ice. You know, I mean, nobody's buying. You know what I mean?
Right.
It's 90 degrees outside. You know, you can get a good price for ice, and ice can fluctuate.
Now, do you feel like with your strategies or like your selection on certain companies, do you feel like you trading in the OEX pit has gave you tunnel vision when it comes to using companies, or are you kind of more so open, like going back to S&P 500 versus the S&P 100?
Yeah.
Do you specifically trade certain companies based off of your experience, or as a retail trader, did that open your window a little bit?
So as a retail investor, I thought I would trade one product, like just SPY, which is the Standard & Poor's 500. It most mirrors what I was used to trading, and it has the most liquidity, tightest markets. I thought that's what I would do exclusively. I now have last time I looked, about 48 different, including SPY, but 48 different individual stocks in my own portfolio. So as a retail investor, I find that there's a lot of opportunities in the Apples of the world, in the NVIDIAs of the world, in the AMD of the world, even the John Deere and the Disneys of the world. You know, it doesn't matter. Wherever there's opportunity, I want to be. When I was a market maker, you know, making markets in one product, that was really all I could do. Like, that was all I could control because I had so much risk in one thing. But as a retail investor, if I want to put, you know, $100 at risk or $1,000 at risk, I'd rather have it all over the place. You know, if you keep all your money in one place, it usually smells like shit. It's manure, you know what I mean? So
absolutely,
it makes it a little easier.
Absolutely, turn it into a good thing, right?
Yes, for sure.
Yeah, and I really appreciate your time, man. Would you? I would like a book tip or any advice on like a book that you would recommend that an amateur trader or anybody that wants to get into options, you know, what's a good start?
So this is going to sound as narcissistic as anybody has ever sounded who you'll ever interview. So a buddy of mine, his name is Tony Rion, wrote a book. He wrote 2 books. They're not really books. They're really they're more like pamphlets, and you can find them for free in a PDF file, or you can go to Amazon and find used ones. And it's really, this is you're gonna laugh when I tell you the title of this book. It's How I Learned to Trade Like Tom Sosnoff and Tony Battista.
Okay.
I'm not kidding you. I shit you not. Yeah. It really is. And they're dated. They're about 6 or 7 years old. So things have changed. And it really is just a guide on strategy. It's not why an option is the price that it is.
Yeah.
It's not who buys and who sells. It's just an overview by a gentleman who self-published it, who English is his second language. You know, he's Mexican. English is his second language. He just has a love of trading and a love for what we do and the message that we're trying to put out there. It's not going to tell you if a stock's going to go higher. Right. It's not going to tell you if a stock's going to go lower. It's just going to give you an overview of, hey, you like ABC stock? These are some strategies. These are the probabilities of them. You hate ABC stock? Here's some strategies. Here's some probabilities. Because like I said, you or I pick 10 stocks. You'll get 5 right. I'll get 5 right on average over time. It's all about the strategies that you apply.
Absolutely.
Otherwise, everybody would have all the big yachts.
That is true. That is so true. But hey, you know, I need the yacht, so somebody else has to make that.
Yeah, I hear you, man. I hear you. You all want our yacht.
Right, exactly. So, I mean, it just sounds like we really just need to just tune in to Tasty Trade every day because it's really just one of those strategies. But I need
it's
to
free. It's free. And sometimes you can't afford free, but this might be one of the few times you can.
I remember the days when I couldn't afford free, but, you know, now I just, you know, try to pay the way a little bit.
That's right. That's right.
But, Bat, I really appreciate your time, man. And you know I'm going to see you around because I'm going to be at events. I was gonna come to Learning Man, but unfortunately,
I remember when you came to our office. It was great. You get your little guy with you. It was awesome.
Absolutely. So I'll see you soon, man. And you know, we'll see each other across social media and everything.
Let's do this again sometime.
Absolutely.
All right. Thanks.
I'll see you soon, man.
All right. Be well. Stay healthy.
I will. You too.
Yep. Thanks, Ty.